Hello, hi, and welcome to Module 4, where we are going to be discussing your go to market strategy. Now that you have validated your problem, come up with a solution, created your MVP, it's time to go to the market. If you look at how this program is completely structured, all of these components that we are working on right now actually will end up getting stitched together in your pitch deck. But more on that later. Let's dive deeper into our go-to-market strategy module. Let's see what all we're going to be covering today. We're going to be covering the basic definition of go-to-market strategy. What does it include? What does it exclude? We're going to understand what are the 4 different stages where your GTMS is going to evolve. We'll cover the topic of market sizing, another very important topic, not just for your company, your product, and what you're going to be doing, but also as a very important question that your investors are going to ask. For all those who are looking to raise investments, this is going to be one of the key questions that needs to be answered for your investors. Then we're going to be working with a 7-step framework that will help you establish your go-to-market strategy. And finally, we'll define your positioning. So let's start. Very simply put, again, the word GTMS is thrown around a lot. It basically means what is your strategy to market your product. It's a fancy word to showcase. Comprises not just marketing, but your market size, your positioning, your value proposition, who are going to be your customers. So all of those things together combine to make a GTMS. In the words of Mark Anderson, great products without great go-to-market strategies often die in obscurity. So let's understand why GTMS actually matters. If you look at it, startups usually have a curve that most startups follow. There is this initial excitement phase where everything goes up. And then there are a few early adopters as well. But once you start marketing your product at a scale, you realize that either your marketing is not working, or your positioning is not working, or the product pricing is not working. A lot of things can start going down, and most of the startups then see a downward spiral. This trough of delusionment, also the valley of death, is where most of the startups die. If you're able to survive this valley of death, that's when you can actually start growing towards sustainable growth and development till the end of your product life cycle, where eventually products kind of plateau and then decline slowly. In order to not die in the valley of death, you've got to have a very, very strong GTMS. You've got to understand not just your product and your customers, but how, where, and when you're going to be marketing. And let's see how you can do that. Before moving into the 7-step framework of defining your GTMS. Okay, so before we get into the frameworks that we are going to be using to define our go-to-market strategies, let's cover the topic of market sizing. I'll cover why market sizing is very important from an investor's perspective in the later modules where we talk about fundraising. But all you need to understand is that for investors to actually make money off your company, they need a big market size. That's all you need to know for now. But let's see how we calculate market sizes. When we calculate our market size, we use a TAM, SAM, SOM framework. TAM meaning the total global available market of your goods or services, what you're trying to get to. We'll understand how we calculate this, but this is the size of the entirety of the market. Then SAM, which is a serviceable addressable market, is the market that we target. Maybe it could be Delhi, maybe it could be New York, maybe it could be India, it could be China, whatever. But you have a market that you are particularly targeting. The smaller or nicher it is to start with, the better it is for your MVP. But from an investment perspective, you want these numbers to be a little on the higher end. Finally, we come to the SOM, which is the serviceable obtainable market. This refers to the market share that we are going to acquire in the market that we are targeting out of the total available market. Right? There are two approaches that you can do. One is a top-down approach where you start with the TAM and go down to the SOM, and the other is a bottom-up approach where you start with unit economics, you start with your SOM, and then try to estimate the TAM from a bottom-up approach. So let's see this with an example of Uber. If this is actually the real market sizing that Uber had published when it had launched. And if you look at it from a top-down approach, the first thing that they estimated, again, when you are doing this, it'll be great if you can cite some very good sources where you get these initial numbers, these statistics. Statista, etc. are great options where you can find these numbers. So coming back to Uber's example, they started off by taking the global taxi and limo market, right, limousine market, which was estimated at 75.8 billion. Then they took the share of the US market from that, which is again 75% of that is the US share. That gives us, considering their initial target market was US, that gave them a SAM of 59.8 billion. Very simply, 75.8 into 70 into the share of the US market. Right, and then they estimated the number of people with a smartphone, because that's what they estimated, that everyone with a smartphone would be a Uber customer. I know it's very ambitious, but again, it was Uber. So they estimated that 85% of the audience was using smartphones, and then they came up with a $50.8 billion market size. Now, top-down approach, I feel, on a personal level, gives a bigger number, and honestly it becomes a little tougher to defend these valuations, these numbers, when the investors start cross-questioning you. I personally prefer the bottom-up approach, where you start with the unit economics, you start with the very basics. We're going to be covering unit economics in our next module, which is the financial modeling module, where we're going to be talking about how to structure your finances. But once you have those basic unit economics in terms of the number of users that you're going to have, what are the average price points, it's always better to start doing your valuation and your market sizing from that kind of a way. I'm not saying either of the ways is bad, but I personally prefer the bottom-up approach because it's easier to defend during cross-questioning. Okay, so when we start with the bottom-up approach, the first thing that Uber did was estimate the total taxis and limousines globally, which was a number around 5 million. Then they estimated the number of rides that every taxi had per year, which gave them total taxi rides per year, which gives them a market size of 26.8 billion, and they multiplied that with the average price of a ride, giving them a number of 268 million, 268 billion as a total addressable market. SAM being 26.8 and SOM being about 10% of that, or whatever market share that they want to get from that. Basically, you are estimating the TAM over here, and then you go back to your estimates in terms of the number of the area that you're targeting to come up with the serviceable addressable market, and then a percentage of that as your market share being your serviceable obtainable market. This is the number which you base your valuations on in a future round. We'll take another example of a company called S25. It's a startup owned by one of our mentors, Arjun Srihari, based out of Spain and Berlin, which is an e-waste cycling startup. So in order for them to estimate the market size, they followed again a bottom-up approach, starting with the total population of the world, then estimating the average e-waste generated by every person, multiplying that to come up with the total e-waste generated every year, and then multiplying that to the cost of the recycled e-waste which was about $500 per metric ton, giving them a total addressable market size of 30 billion. Right? Then they calculated that 20% of this e-waste is actually collected and recycled, and that is the market that they want to target. So 20% of that gave them a 6 billion SAM, and they estimated that out of all of this market, they'll be able to capture about 15% of the market share, being one of the early adopters in this space, giving them almost a 900 million SOM. Now your GTMS strategy is going to change according to the stage, life cycle of your company, right? At the initial stage, while you are still doing a problem and a solution fit, you're going to have a different GTMS, a GTMS which caters to your early adopters. Once you have your early adopters, you've proven the business model, you understand that the product has demand, you reach a place called product market fit. Once you reach product market fit and you start seeing that your customers are deriving value from your product, your GTMS is again going to shift, because from an initial experimentation, now you go more towards a consistent path. Once you have established that your product market fit has been established and your go-to market fit has also been established, you want to understand how you can scale this up. Every time you scale campaigns, most of the times they are not going to work exactly the way that they worked on a smaller scale. So you will have to revamp your GTMS again. And finally, once you've reached that scale where all your product market fit, problem solution fit, go to market fit has been established and you want to dominate the market, your GTMS strategy is again going to change. So it's going to change based on the time that you spend, on the stage of your company, on the life cycle of your company or the product. Cracking GTMS basically needs you to have a 7-step clear framework. Now, the clearer you are on these aspects, the better it is going to be for you. Let's understand what these 7 steps are. First, you've got to identify your audience. Now, all of this is going to change based on the stage of the company, as we discussed earlier. So first step, you identify the audience for that particular stage of your company. Second, you benchmark yourself against competition. Third, you position your USPs. What is it that users are coming to you for? We're going to dive deeper into all of these things soon. So just listing them down for you first. Fourth, you need to come up with a pricing plan that is a win-win, something that helps you make money, or rather not burn too much money initially, and also helps your customers either save time, save money, optimize their resources, increase their efficiency, whatever. It has to be, the pricing has to be a win-win pricing for both the parties. Fifth, you want to activate 1 to 3 distribution channels, the ways that you're going to promote your product. You want to understand there are so many channels. Again, we're going to discuss all the channels which are available, most of them, and we're going to see which ones make sense for you depending on that stage of your plan. Sixth, you want to have some kind of a loop into your cycle. Maybe it's a growth loop, a viral loop that helps you organically grow, that helps you grow through word of mouth, through social sharing, or people recommending to others who are facing the same problems. Finally, you want to have some kind of measurement, some kind of KPIs, key performance indicators that you're going to be tracking that tell you whether the experiments that you are doing are a success or not, or if there is something that you need to change at some point of your go-to-market strategy. Again, so these 7 steps together comprise your entire go-to-market strategy. And now let's see how we go about all of those things. At an early stage, it's always very good to niche down your audience as much as possible. If you're very focused on one particular set of people, if you're very good at solving their problem in the best possible way, that's the best way to grow today. I often say that if you're going after everybody, you're going after nobody. If you're creating a product for everybody, you're creating a product for nobody, because today the solutions that are there in the market are highly targeted and the solutions actually solve the problems of one particular set of people very well before they move on to the next set of people. Again, we took the example of Airbnb in the previous module where we understood how they created their MVP, but that's also what they did with their GTMS. They targeted that very specific budget conscious group of people who were coming to California for a weekend conference, and that's what they went out after first to establish demand. Again, as your company grows, the number of people, the audiences that you're going to be targeting will keep increasing. But to start with, it's very important to focus on that very high pain point slash willing to pay kind of people. And to simplify that, just use again a 2x2 matrix. On one axis, have willingness to pay. On the other axis, list down the intensity of payments. Then categorize between 1, 2, 3, and 4. Put the people in, like, create ICPs, which is ideal customer profiles. Let's say you're creating something for working mothers. So if that pain point is being solved by your product solves a pain point for working mothers the best, and they have that pain to an intensity that they are very willing to pay you, they become your ideal customer profile. They fall into category 1. So just categorize your ICPs into 1, 2, 3, and 4 based on this framework, and you'll know which audience to go after first. Once you've identified your audiences, you benchmark your services against competitors. You compare the product, the positioning, the acquisition channels, the experience that their product delivers, and the pricing of their product. You've got to be very aware of what exactly the competition is doing so that you can differentiate yourselves, or in case they are missing out on something that you feel is a bigger pain point for your audience. If you're aware what the competition is doing, you'll be able to adapt very quickly, change very fast. You'll be able to learn from them, but also innovate on top of that. Next, you want to position your product, right? And for that, we use a FCB framework for all the Real Madrid fans. This is not a Football Club Barcelona joke. Never mind, I don't like Barcelona, but please don't hate me for that. So we're going to come back to the positioning part. So this is our FCB framework where we list down the feature, capability, and benefit of your product, right? And here are a couple of examples of Slack and Nike. So Slack, as you know, if you had to list down the feature, it's a channel for team communications. The capability that it offers is that it organizes information by topic or project, and the benefit that it offers is it improves collaboration and declutters your email. So similarly, here again, take a moment, pause the video, use this framework, and write down the features, capabilities, and benefits that your products are going to deliver. You can have maybe 2, 3 rows over here. All right, next we are going to be discussing about pricing. Again, one of the very important parts of your GTMS that you might want to crack early. You obviously don't want to price yourself too low and leave anything on the table. But you also want to ensure that your users come to you and your pricing is not so high that they just let go of your product despite the benefits that they are getting. My suggestion during the early days is to avoid overcomplicating your pricing. Don't come up with multiple tiers, pricing based on location, things like that. Look at the example of ChatGPT, right? The basic plus version coming at $20 flat for everyone across the world. Very simple, very basic, and it's a value-based pricing. That's the best way that you can price your product, based on the value that your product delivers to people. Your pricing could also be brand reflective. You could price your product much lower than the existing players in the market, trying to penetrate a bigger share of the market initially. Or you could price them at par with them. Or you could price them at a premium where you're charging a lot more showcasing the higher quality of your product or the limited availability and creating a demand supply gap in the market. You could, as I said, have objectives where your objective could be maximizing revenue, it could be market penetration, it could be a branding objective. So it depends, right? Here are a few ways that you can price your products or services. Value based, I feel, is one of the best ways to price your product based on the perceived value of your product to the customers, right? Not just what you feel that they're getting, but what they feel that they're getting out of the product. Today, I'm very happy paying the $20 to ChatGPT. Why? Because I know I'm making a lot more in terms of the time saved, cost saved. I don't need extra resources. My market research happens much faster. I mean, among other things. So that's a value-based pricing. Like, I feel that the $20 is much cheaper in terms of the output that I can get out of that product. And that's probably also one of the reasons why people across the world are paying so much for a service like this, and it became so popular so soon, right? Next, you can price your product based on the market, based on what your competitors are charging. If it's still early days for you and you're not very sure in terms of the final value that your customers are going to get or the long-term value that they're going to get, you can always use your competitors as a benchmark. I mean, this does assume that your competitors did a good pricing exercise, but again, make sure that you're not entering a place where your product or a service becomes commoditized. Because if that becomes commoditized, by the end of it, it's always going to be a price war. If your product is the same as your competitor, all they have to do is lower the price to steal your customers. So make sure that there is some differentiation in the product and then price it accordingly. The third way that you can use to set your price is a cost plus model, where you understand the basic costs of creating the goods or the service. You put a markup on top of that ensures your profitability, and then you sell. This does at times leave out things on the table. Maybe your product's perceived value to your users is much higher as compared to what you're going to charge them on the cost plus basis. So you're leaving a lot on the table. But if you feel that you want to do a deeper market penetration, or you can adjust pricing later, this is again a great way to start, while you also ensure that your company grows profitably. Now that we've discussed most of the things, let's go to our channels. What are going to be the ways in which we promote our products or services, and how are we going to basically choose the channels? There are 4 basic categories. We're going to come to the different channels over here in these categories, but overall there are 4 major channels that you can use. One is an inbound. Basically, you are there, your customer comes to you. One is outbound, where you reach out to the customers. Third is paid advertisement, basically your social media advertisements, search engine advertisements, banner ads, things like that. You can also enter into partnerships with people, pay them some kind of an advertisement revenue or some partnership commission or something like that, where they actively promote your product. This is again a great way to grow. So a few examples of the channels that are available. You could use your personal brand, your personal network. SEM stands for search engine marketing, basically on the likes of Google and Bings of the world, where you pay and advertise. JVs refer to joint ventures or partnerships. SEO is the organic way of bringing traffic. You see, when you search for something on Google, there are so many pages that you can go onto. How you rank on top of them ensures that you get more or less traffic based on where you are ranked, and that is SEO. You can build communities, forums. Today, I feel building communities is again a great way to distribute your product, and once you have a hold on the distribution, you can push out more products also in the future. So today, it's very important for most people to have some kind of a community in their product. Social media ads, you can have tech integrations. I mean, for example, software products that can integrate yourself. Like if I were a CRM software, I would want to integrate with a Facebook, or again, integrations that you can create. You can always use emails and newsletters to keep people updated on the new launches, new features. Telemarketing was a great tool earlier, then people started thinking of it as spam. Today there are AI based telemarketing techniques, but again it goes under the spam category a lot. Influencers as a marketing channel is on a rise again, especially the micro and the nano influencers who are very engaged with their communities. You could also have franchising and licensing deals as you grow. Webinars again become a great tool, a lead magnet to attract people by giving them something free, and by the end of it you upsell them into different products and services. Cold emails, again, emails still have a good read rate as long as you're not overdoing it. You can look at affiliate marketing. There are a lot of people who promote your product for a small percentage of the sales, and you can also create alliances with other people. So these are a few of the channels. I won't suggest you to go after all of them, but highlight the 1 or 2 channels that you're going to be using to promote your product at an early stage. Right? And now let's move on to having loops, growth loops. Growth loops are basically a fact that you already have a user and you've spent a lot of money, time bringing this user. So you prompt your user to do something that by the end of it becomes an outcome that they're able to share with others, and that sharing in the process brings you new users. There are 2 types of growth loops that I would suggest. Either at least have one of them in your product. The first being a viral loop. So for example, a user takes a super cool website personality quiz. The user downloads the result as a page designed for sharing. And once you have that page very beautifully designed that people can share, the user shares it on social media, creating social buzz, creating more traffic, and that traffic ultimately comes back to your product. They take the quiz, and then that becomes a growth loop, a viral loop for your product to grow organically. The other example would be a referral loop, right? You would seen a lot of companies, especially in the early days, have this refer and earn option. Why do they have that? Because you are reducing the customer acquisition cost for them. Again, an example would be a user signs up to get, let's say, a personal badge. A good example of this kind of a product would be a company called TopMate that grew very fast. For people on LinkedIn, you would have seen that recently. They do this. You sign up on TopMate. It prompts you to share badges, share on your social network. You earn points, rewards, things like that. And every time you share, a referral link is generated that you can share with your friends, and more people end up signing up to the product. Okay, so now you have your audience, your positioning, your channels, your pricing, everything ready. The final step is to establish key performance indicators. Because it is rightly said, if you can't measure it, you can't improve it. And that's the entire thing about your startup journey. You've got to make incremental progress. And that only happens when you have established KPIs for everything. I feel the most important North Star metric for any kind of early stage startup has to be week on week revenue growth. Now, this is a combined metric, but let's break it down. Why week on week? Because day to day is too short to track. The changes that you make, experiments, do take at least a day or 2 to reflect into the system. So week on week gives you a good time balance. Month on month, quarter on quarter are too slow for you to change your GTMS or change your budgets or change your positioning. And you basically slow down if you track those metrics. So week on week. Now revenue growth, not just revenue, but revenue growth. How fast are you growing? And this is also something your investors are going to look at. If you can showcase 2-3 months where your week on week revenue growth is greater than 5%, you're good to go. If you look at benchmarks, anything less than 1% is very weak. 5 to 7% is something that you should target for your week on week revenue growth. Anything above 10% over a period of, let's say, 1 quarter or 2 quarters is absolutely phenomenal. You're on a path to rocket scaling. So there are multiple basic KPIs that you can have for different aspects of your business. Let's say when we talk about your acquisition channels, you can understand the amount of traffic that is coming, the traffic that is coming through different channels, how many of your leads are actually qualified leads, what is the scoring of that lead, what are the conversion rates, what is your customer acquisition cost, what is the lifetime value of your customer. And then when we talk about customer experience, you could have how many people who actually downloaded your app are using it daily, monthly, basically daily active users, monthly active users, your engagement duration, churn rate, retention rate, net promoter score, repeat customers, again, a very important key KPI, ticket sizes of your average order value, basically. When we talk about product development or tech, you can have KPIs in terms of the feature roadmap with deadlines assigned, and you can keep a track whether the feature development is on track or not. You could understand the speed, latency, the load time of your site, adoption rate of your features, error rates, the number of bugs that are there in your product. So all of these things, again, you can track. I won't suggest you to track everything, but see what is more important for you, what moves the needle for you, and then assign a KPI for each of these categories, maybe 2-3 KPIs for an acquisition, maybe at an early stage, retention at a later stage. When we talk about operations, you have your operational expenses, your gross margin, what is the servicing cycle, how efficiently are you solving the problem, if there are automations, if there are service resolutions happening on time. A lot of companies today take pride in how fast they are able to resolve customer queries. Again, AI has made it very cheap, but if you are looking for a more premium positioning for your product, I feel today having a human being behind customer service signifies a very premium positioning. How long does it actually take for you to respond initially to a customer complaint or a ticket raised, number of tickets raised, all of these things you can keep track of. Cool, so those were the 7 steps that make up your entire GTMS. I have one small framework for you. In fact, I would love if you could pause your screen during this, pause the video during this, this part of the module and try filling it up for yourself. I'll show you the framework. I'll give you an example. You can come back to the framework and then do it for yourself. If not during the module, but after you finish this module, do create your GTMS before you move on to the next section. Okay, so we have a 3-part GTMS canvas. The first part, you list down your superpowers. What are your opponent's weaknesses? What are some of the things which are mission critical? And what are the success metrics? I'm just giving you the framework. I'll explain it to you with a example. In the second part, you understand the problems in the market. What are your expected customer profiles? What are the key features of your product? How is your positioning going to look like? What is your pricing strategy going to be? And what does growth look like for you? And finally, you come up with this 3 lines where the yellow part is basically, the highlighted part is basically a fill in the blank for you. I've given you a suggestion. The idea for you has to be to come up with a very clear 3 line, and you'll be able to come up with this if you follow the first 2 parts of the canvas. So you will achieve the target for your company. by offering X product to X expected customer profile, which helps them with this particular unique value proposition. This product is the best fit because your unique selling proposition will be sold at a price and a billing model. To promote your product, you have selected this particular channel and have created this particular viral loop. That's your entire GTMS in 3 lines. And to achieve these things, these are the 5 things that you need. I know this might look very abstract at the moment. Let's see how a food delivery app would use this canvas. Right? So when they talk about their own superpower, what are their advantages? It's a new food delivery app which is going to launch, and this is what they created as a GTMS. They wanted to focus on flexibility. They wanted to have a budget for paid channels, and they wanted to create a country-specific approach. The weaknesses that they identified in their competitors was that they were neglecting smaller markets, there was lack of focus, and they had a one-size-fits-all strategy that probably does not work today. For them to be successful, what was mission critical? They wanted to do rapid penetration. They wanted to capture the market share very fast, and they wanted to have a localization specific policy. For them, success metrics look like 40% share of the key markets. They wanted to optimize the number of orders per day, per month, and the number of partners that they had, delivery partners or restaurant partners that they had in every city. These were the 3 success metrics that they had. So when they talk about the market, what are the conditions of the market? Big players neglect small markets. Growing demand for food delivery. Large market share enables network effects. Right? This is a market where network effects are very easy. The more number of restaurants you have, the more users you have, the more users you have, the more restaurants you have, and it becomes a vicious cycle of exponential growth. That's what network effects means. Expected customer profile, customers who want local offers, who are ready to pay a premium for good service, and people who want more choice. In terms of the key features of their product, they had a 30-minute food delivery guarantee. Their product was, your app was, or whatever platform that they were using, very user friendly. For them, product market fit means users with at least 1 order per month. In terms of their positioning, there's always something new to discover. The best local restaurants are available on the platform, and they wanted to become the first choice food delivery partner for each of their users. In terms of pricing, they decided a 10% per transaction cost, then ad revenue from restaurants, ranking restaurants above each other based on how much they pay, and then a lower delivery fee so that users are not charged too much upfront. In terms of growth, they used a paid marketing strategy, search ads, viral social media content, PR, influencer strategy, and also outdoor ads. Now, if we were to summarize the entire thing into the 3 lines of the GTMS canvas, this becomes the GTMS line for the food delivery app. We will achieve all of these things that are highlighted have already been decided in the past 2 frameworks. We will achieve a 40% market share in key markets by offering what? The product. Food delivery services to who? The customer profile. Customers who are ready to pay for goods and services, for good services, which helps them get what? The unique value proposition. Get food delivered in 30 minutes. The product is best fit because the USP, it collaborates with the best local restaurants, and it will be sold at a low delivery fees, the pricing model. To promote the food delivery app, the product, We have selected what channels, paid ads and viral social media content with influencers, and created a growth loop for virality. Very simply put, the entire GTMS, whatever we covered in this module, in 3 lines, summarized. So when you are going to be pitching to your investors, these are the 3 lines that you need to know, and then the logic behind that, you can always convince them. To achieve these goals, the mission critical things that they need are a 3 people local team, paid ads budget, influencers and creative PR, agreements with popular restaurants, and reliable delivery partners. So go back to the framework and do this for yourself after the end of this module. Send us your 3-line GTMS. We'd love to see what you created. If there is any question, doubt, feedback, as always, we're more than happy to answer them. And we look forward to seeing you in the next module.